In the United States, the Fed has created vast amounts, and the reason I have this chart up, we're going right to this chart right here about the difference in the way that the U.S. and China have dealt with this particular problem. Shall we call it the output gap, for lack of a better term? In the United States, what the Fed has done, it's created all this liquidity, buying various assets and putting the money out into the system. But the assets bought do not create productive or non-productive investment because they enter into the financial system, but they don't, by and large, leave the financial system. So we have not, in the United States, had a housing boom, meaning a construction boom, the past several years. We have not had a factory boom, meaning the building of new production facilities. Because although the Fed can create money, it cannot enforce and direct its use. So the money just sits there. Excuse me. It's one effect, and the way the Fed attempts to do this, or the way the Fed theorized that it would help, is through the wealth effect, where it bumps up the stock market and other markets. And we have seen this. I don't put up a chart of the Dow because that's a chart we all know very well. So the Fed's best anticipation for how its monetary policies work is indirect. The Fed creates liquidities. Banks may or may not lend it out. They're probably not. Why would a bank be eager to take on a 30-year mortgage at 4% or 3.5%, knowing that it's going to become increasingly difficult to fund that mortgage as time goes on because rates are bound to go up at some point? So what would be the real advantage and the real incentive for banks to lend out at historically low rates? Probably isn't any. It does, however, pump up the stock market and the other trading markets. How much wealth effect is there back into the economy? It's always been my opinion that it's minimal. Yes, it's true that a vast majority of Americans have some stake in the stock market, but most of it's relatively small, and it's through retirement accounts, 401ks, stuff like that. It's not the type of wealth that is readily accessible to the consumer. The small percentage of the American population that does benefit directly from an increase in stock market is, one, probably more financially sophisticated, less likely to go out and spend what could very easily disappear. So the wealth effect has always been minimal. What's the difference in China? The difference in China, now remember, all the central banks of the world deal with this stuff in the same way. They all created money. They all tried to pump up and close the demand gap, or the output gap, excuse me. But in China, the way that it takes place is very different. The mandarins, and I think it's perfectly acceptable to call the Chinese Communist Party officials who run the government and the economy in China mandarins, as the old imperial bureaucrats were called. I don't know if the Chinese current civil service is as rigorous and demanding, and probably also as stultifying and as hidebound as the old imperial bureaucracy became. Remember, China's historical method of renewing its government is overthrowing the ruling dynasty. The mandate of heaven, as they called it, has been removed, and you get a new dynasty. The current dynasty in China is how many years old? 1948. So that's 64 years? No. 54 years. That'd be 98. 64 years. Anybody got a calculator handy? All of our math skills have deteriorated. I think my kids are probably better at arithmetic than I am. That is not a long time in the history of Chinese dynasties. So putting the current Chinese government in historical context is something which is quite sobering to do and sobering for them to do as well. In China, the method that the government and the central bank, but they're really the same thing, have used to foster demand, to foster employment, to keep the economy growing, has been to not create liquidity and fling it out into the market hoping that it will do something, but to direct loan demand out into the economy. But if you are a Chinese construction company or a Chinese development company, and you're the recipient of a loan from a bank, you don't sit on it and you don't put it into treasury bills. You go out and build something. You build housing, build apartments, build factories, you build office complexes. The method that China uses, because it's one reason is because its financial market is so much less developed than the United States, is to build something. So here we are looking at all China. Let's look at this one. All system Chinese financing. Now, there is a certain cyclical nature to financing in China. And you can see it because you get peaks at similar times. Look at this. You had a March peak here. You had a March peak here. And a March peak here at similar times. But the distribution is, you don't get an accurate picture of it because this is based on when the demand as a monthly function, as is when the loans are created and dispersed. But a loan peak like this or this, what it does is it then creates the money, which then continues to work throughout the economy, the loan, for the next 6 or 8 months or a year as the projects are built. So this is like boosting the thermometer in your home up to 80 for an hour, knowing that will keep the home warm for the next 3 or 4 hours. It's a similar concept here. The Chinese government orders these loans. They get distributed out through the system, and then the loan money is spent for the next 6 months or a year warming the economy. That's what you see in this distribution.